Welcome to this very special edition of Value Research Helpline. Here's wishing a happy Diwali from everybody at Value Research to your family. I'm Ruchira and our experts here at Value Research are now all set to answer your queries on investing and personal finance. Joining us is Ashutosh Gupta, Vice President, Value Research. Welcome, Ashutosh.
Thank you, Ruchira.
Now, today's first question comes in from Abel, who's planning to start an SIP for his newborn's future education needs. Abel wants an SIP in both a multi-cap as well as an aggressive hybrid fund, amounting to a total of 6,000 rupees a month, which he plans to increase yearly by 10%. He's asked for your advice on this, Ashutosh.
Well, children are God's gift, but an expensive gift, isn't it? I mean, right from their childhood to adolescence and even later, you work hard to not let money come in the way of their growing up. Now, specific to child education as a goal, there are a couple of unique things about it. One is, it is very difficult to precisely estimate how much money would be good enough because you don't know at this point in time what would be the career option that the child would choose. And for different career options, the amount of expenditure that might be facing you could be significantly different. So the best that you can do right now is to make an early start, and then keep refining your goal as you get more clarity. And to that extent, you've done it very well by planning to start at this early stage, which will give you a big head start. Now, in terms of the funds that you mentioned, I think multi-caps and aggressive hybrids would fit the bill because this is a very long-term goal. In fact, only pure equity funds or the multi-caps can do the job. But to manage the day-to-day volatility, if you want to add a little bit of fixed income to handle that volatility better, then even aggressive hybrid funds can do the job. So you can go right ahead with that plan. Now, the other important aspect about children and money is, although it's very early for you to be doing that, but just for the benefit of our other viewers, it is very important to give your children those early lessons in finance which formal education would not teach. So as they are growing up, tell them about how money moves into your life, the way money comes into the household, and then how it is spent on different needs. Start the concept of home banking, the good old good luck system that we have at homes, so that they understand and learn that small amounts accumulated over a period of time do become big. And these lessons would go a long way in their financial life till long after you have stopped providing for their finances. Wish you all the best.
All right, the next question comes in from Razia Khan, and she says that Value Research often suggests opting for high quality, short duration debt funds to a fixed income investor. But how does she decipher a high quality one from the rest, as on VR website, their credit quality looks quite similar?
Well, that's a good question. Let me provide a bit of perspective there. So if you look at this point in time, yes, a lot of those funds would look pretty good or pretty similar in terms of their credit quality. But I'm sure you would have heard that saying, the true character of a person is tested in bad times. Well, if that person happens to be an investment professional, I'd say it's the other way around. So the true character of a fund is tested when it's easy to assume risk and easier to justify it. Now, one of such phases that came in the recent years was that time period around about 2017 and early 2018. And that's when you see a lot of differences in the risk levels in different portfolios. So the broad point that I'm trying to make here is that rather than looking at fund portfolios at a particular point in time, an ideal approach is to look at the way the portfolios have been managed over at least one complete market cycle. And when you do that, you realize the differences, the kind of investment discipline that a particular fund keeps during tough times and good times, and what is the kind of risk that they assume at different points in time. Ideally, we at Value Research prefer funds which do not deter from their investment discipline even when temptations are high, when the ability and the temptations to assume higher levels of risk is high. That is when the true character of a fund is revealed. And that's why I say that you have to really look at a fund over an entire market cycle. And that's what we try to do when we bring our analyst choice selection to you.
All right, now Amit Majumdar has invested through SIP route in L&T Business Cycles Fund for the last 4 years, but due to poor performance and high volatility, he stopped this SIP for now. He says that the invested amount and market value are almost the same and wants to know if he should redeem or continue holding.
Well, L&T Business Cycles Fund hasn't been able to build a very compelling case for itself. On top of it, both its direct and regular plans are fairly expensive in terms of the expense ratio vis-a-vis their peers. So I'd say that there is a case to look for better alternatives. In fact, within the same fund family, L&T India Value Fund presents a far more compelling case in terms of its long-term track record of performance and also the kind of expenses that it has. So that could be one of the options for you to consider.
Amit has assigned 80% of his savings to various fixed deposit schemes, but recently there has been a substantial reduction in the interest rates. So he wants to explore other options of investment, which will fetch him interest rate of about 8 to 10% per annum, instead of depositing this amount to his savings account.
Well, 8 to 10% return expectation from your fixed income allocation at this stage looks like a fairly optimistic one. So first is you have to moderate your expectations. I mean, at this point in time, there would be certain bonds and certain high yielding fund categories which can yield upwards of 8%. But then you have to remember that they will come with their own set of risks. So at best, you can only have a very small allocation from your overall allocation to these kind of investments. A high quality bond portfolio at this point in time, you can expect in the next 1 year, maybe returns in the range of around about 5.5%. So that's the kind of expectation from a high quality bond portfolio that you should have at this point in time for the next few quarters. Now, if liquidity is not an important parameter for you, and if you can lock your money in, then some of the options outside of the mutual fund domain, for instance, for an accumulator, options like the national savings certificates or the PPF with the 6.8% and 7.1% returns look quite compelling given the kind of environment that we are in. Or if you're a regular income seeker, then options like the senior citizen savings schemes or the Pradhan Mantri Vay Vandana Yojana look very compelling with their 7.4% returns. So those are the ones you can consider to bump up your yields if liquidity is not a consideration. But otherwise, really, you need to moderate your expectations and you have to live with the kind of low interest rate environment that we are in right now.
Himanshu Bhatt has a sum of 20 lakh rupees with the time frame of 8 years. He wants to know where the amount should be invested.
About 8 years, I'd say that go for aggressive hybrid funds. These are the category of fund which invest about 65-70% of your money in equity and the remaining in debt. But remember that these funds would also be volatile on a day-to-day basis, but over your entire holding period, they can be suitably rewarding. The other important aspect to note is that do not commit this 20 lakh at one go, spread it over the next 1 year and hold it for the remaining 8 years.
All right, the next question comes in from Ganesh Krishnamurthy, who's asking how is performance measured vis-a-vis NIFTY on Value Research Online? Is it possible to include this? Further, he finds the performance dashboard with inflation-adjusted figures little confusing and wants to know if there's a primer on how to use the tool.
Okay, so to answer his first question, yes, that functionality about comparing your returns with an index like a NIFTY is there in our My Investments tool. If you go to the performance tab of the My Investments tool, you can figure out that if you had invested the same amounts and on the same date as you had invested in a particular fund, instead of that, if you do that in an index, then how much more or how much less you would have made. So this kind of insight on every single investment that you've made is very much possible to derive from the performance tab of My Investments tool. But this functionality is disabled in the free version of this tool, and you need to be a subscriber to the premium account to be able to get this information. Now, the second part of this question deals with the inflation adjusted returns. So this basically tells you the real returns that you've made. So for instance, if the total annualized returns that your investments have fetched is about 9%, and during this while the inflation has averaged at about 6%, so the insight that you get from that graphic is that your real returns, the actual returns that you've made in a real sense, is about 3% only. And this piece of insight could be very revealing for those who've been fixed income investors all their life.
Now, L. Doraiswamy wants to know if pharma and technology funds will give better returns as their stock prices are rising by the day, and market expectations are also that these sectors will do better.
Well, I'd say that different sectors tend to perform at different points in time, but it is very difficult to time your entry and exit from a particular sector depending upon when they perform and when they not. Taking the case of pharma, as you've mentioned, it has done very well this year. The last time it did so well in the context of the overall market performance was in 2015. But in the intervening years, its performance has largely been average to a laggard. So the broad point I'm trying to make is that there is merit in being diversified, fairly diversified, not focused too much on individual sectors, but rather focused on picking a few good diversified equity funds and then really leave the job of deciding which sectors or stocks to be invested in to a fund manager. If you notice, when these sectoral shifts or the performances happen, you see these changes also reflecting in the portfolios of the diversified equity funds. So if you make a separate allocation to sector funds over and above your diversified equity allocation, you might get overexposed to a particular sector. So for majority of investors, the sectoral allocations are avoidable. Stick to a diversified equity fund, and the changes that that fund makes to its portfolio should reflect the sectoral performances in your overall returns itself.
Our next query comes in from Love Kumar, a 64-year-old retiree with a 35 is to 65 in debt to equity allocation of funds. He wants to know if he should redeem investments from his PMS and invest the same for wealth maximization. He also wants suggestions on mutual fund schemes or options in debt and equity.
Well, in my opinion, mutual funds are a superior option to PMS simply because mutual funds are better regulated, they are more transparent, they are less expensive, and they are also much more tax efficient. So from all these perspectives, there is a stronger case for mutual funds vis-a-vis the PMS. Now, in terms of what kind of funds he should go for, matching to his 65-35 equity debt allocation, the aggressive hybrid funds would fit the bill to keep the same kind of target asset allocation. These are the funds which generally keep their equity allocation in between 65 to 70% and the remaining in debt. And this really is the simplest way to achieve the target allocation that he has been maintaining so far. But if he wants to take more control and he wants to build out his allocation by himself, then he can also go for a couple of good short duration funds along with a couple of multi-cap equity funds and distribute the money to again achieve that 65-35 asset allocation. Now, the benefit of this approach would be that he'll be able to choose the best of both worlds, the best of fixed income and the best of equity funds that are out there. Building it by himself would also give him a little bit of a cost advantage because overall the costs of this allocation would be lower than what he would have to incur on a hybrid, on an aggressive hybrid fund. But on the flip side, it will require a little more effort, a little more monitoring, regular rebalancing, at least annually. So it would require a little more effort on his part. So really he can make his choice between these two. If he wants to go with a simple plan, then nothing beats a couple of good aggressive hybrid funds. But he wants to do it himself, then a portfolio buildup of a few short duration and multi-cap funds can also fit the bill.
Nalin says the markets have rallied since March and are overvalued too. So he wants to know if it's advisable to initiate new investments now if he has some good fundamental stocks in mind.
Well, whether this is the right time to invest or not is a dilemma that he will always have, just like any other investor. And that's the whole reason why in equity, one should not commit too much money at a particular point in time, but really stagger the investments. So my advice to him would be that if he already has identified a few good, fundamentally strong stocks, and he is looking to remain invested for the next several years, then the right approach would be to stagger his investment into these stocks over the next few months rather than committing all of that money right now at a particular point in time. And by doing that, he would not have to worry too much about the current market levels. In fact, that's how even fund managers build their positions in their strategic holdings. So that's a simple plan that he can follow.
NM Soni asks, other than index investing, what are some commonsensical DIY methods of investing in equity if for someone who has patience but cannot do deep research?
Well, let me give you my list, which I believe is fairly easy to implement. Let me give you my 6-point list. Do an SIP even if you have a lump sum. Diversify, but don't overdo it. 4-5 funds are good enough. Invest only a measured dose of your allocation in high risk categories such as mid caps and small caps. There would be times when these funds would run far ahead and these funds would look far more compelling investment options than any other kind of fund that you have around. But that doesn't mean that you get carried away and commit substantially to them. So that's point number 3. Avoid taking a call on the markets and invest opportunistically. And that links back to the point number 1, where stick to a good old SIP method of investing. Uh, Review your investments once a year and make any necessary changes in terms of rebalancing your asset allocation once a year. And finally, look to exit systematically the way you invest. If you follow these 6 points, you would by and large be fine.
All right, the next question comes in from Richard D'Souza, and Richard wants to know what kind of funds are better, actively managed funds or index funds?
Well, if you look at historically in the Indian context, actively managed funds have done far better than the index funds. But of late, particularly in the large cap category, index funds have built up a very compelling case for themselves. And the reasons are, 2 or 3. One is that ever since SEBI undertook the reclassification exercise, the investment mandate of large cap funds has been fairly restricted. So earlier, they could outdo the broader markets by having slightly higher allocations to mid and small caps. But now that has been curtailed down to a significant level. And within the restricted universe of stocks, now from which they have to build a bulk of their portfolio, it has really proved to be very difficult to generate alpha. And that links to the second reason which is really market efficiency. So in the broader well-tracked universe of large cap stocks, it has genuinely been difficult to outdo the markets. So for these reasons, index funds have started putting together a very compelling case vis-a-vis the active funds. And also the other advantage that they have is the low costs. So in the large cap space, I would say certainly index funds are worth a look. But once you move to other categories which go down the market cap segments like the multi caps or the mid caps and the small caps, it is by and large actively managed funds that rule the roost. Also, these are the categories where there are not a lot of options available in passive investing. Also, once you move to categories like small cap, replicability of the index itself could be a challenge for a fairly sized fund. So I'd say that in these categories, it is still actively managed funds that are the way to go.
Vimla has invested in the direct plan of ELSS scheme and selected the growth option, but she's been told that the dividend option should be chosen over growth, and she wants to know why is it so? If she should invest from the growth option to dividend option now.
No, I think she's taken the right decision of investing in growth options. So she should completely ignore the advice regarding the superiority of dividend options and continue with the growth plans. Now, contrary to general perception, dividends is not something extra that you get. On the contrary, dividend options happen to be much less tax efficient going by the current tax laws that are prevailing right now. Just to explain that further, the dividend that you receive is added to your income and taxed as per the slab system. So if you're in the 30% tax bracket, then you pay 30% tax on the dividend that you receive. Contrary to that, in a growth option, the capital appreciation that you achieve, as and when you sell your fund, the capital gains that you have on that are taxed at the rate of 10% if your holding period has been more than 1 year, or otherwise they are taxed at 15% if your holding period has been less than 1 year. And that too over and above the 1 lakh threshold limit of capital gains. So the first 1 lakh of capital gains that you make in any financial year are exempt from tax. So on these counts, growth option happens to be the more tax efficient one. The other important point to note is that in case of dividends, your entire dividend income is subjected to tax. But in case of growth option, it is only the capital appreciation bit. And I'll explain that with an example. So let's say in a particular year you get 10,000 rupees as dividend income. Now this entire 10,000 rupees will be added to your income and subjected to tax. Whereas in the growth option, let's say you redeem your units worth rupees 10,000, then this entire 10,000 will not be put to tax, but only the capital gains bit of these 10,000 that will be put to tax. And even after over and above the rupees 1 lakh threshold, which is exempt from tax. So clearly growth option is far more compelling and far more tax efficient, and you should continue to stay invested in those.
Okay, so our next question comes in from Somer, who wants some basic advice about his investments. Somer says his fund is doing well, so should he redeem the units and book the profit already made? He then plans to buy the units of the same fund with this money. Does it make sense, is what he wants to know.
No, it does not make sense. This round tripping will achieve nothing but saddle you with some exit loads and some taxes. See, the point is that this round tripping of selling your units and immediately buying back, the profit booking is only a matter of mental accounting. It doesn't change anything in real sense. It doesn't make any difference to your overall finances or your overall returns. On the contrary, as I said, it only sets you back. So every time you do this, you have a little less left to invest back. So by all means, do not go ahead with this and continue to stay invested.
All right, now Dheeraj Verma asks if it's a good idea to do SIPs in small amounts rather than buying bigger amounts so that they can be sold in different years to save on taxes.
Well, I'd say that your SIP should be a function of your goal and your time horizon. Or if you're not investing for a specific goal, then your monthly SIP amount should be a function of how much investable surplus are you able to generate every month. So I'd say that don't complicate things by over analyzing. Simply decide what is the kind of amount you can spare every month to invest and go ahead with investing that. As far as taxes are concerned, for one, you don't even know what would be the tax laws governing your investments a few years down the line when the time comes to redeem this money. So just keep it simple. Don't overcomplicate. Figure out how much you can invest. Start investing in a few good funds and keep monitoring these investments at least once a year, and that will do the job.
All right, today's last question is from Jess Augustine, who finds two popular mutual fund advisors contradictory. One that promotes goal-based investing, and the second one that discourages from investing in too many funds. Jess wants to know if he has 5 long-term goals of 15 years plus and 3 not-so-long-term goals of 6 to 10 years, how many funds should he pick?
Well, I don't think those two pieces of advice are necessarily contradictory to each other. So following a goal-based form of investing doesn't necessarily mean that you should have separate funds for each of those goals. In fact, for the 4 or 5 long-term goals that he has, he can continue to have the same set of 4 or 5 funds in which he invests. In fact, he may not even need to invest separately for each goal. He can continue to invest that same pool of money as long as each of those goals are planned for and accounted for in the total amount of money that he's investing. Once he does that, then all he needs to do is continue to monitor these investments through an annual review. Keep a close watch on any of these funds if they start to slip in performance. And if that persists, maybe take a hard look and take a call to move to a better alternative. That's all there is to it.
Well, that's it from us. Thank you, Ashutosh.
Thank you.
Thank you to all our viewers. You can go to VR Helpline on Value Research online and send us the questions that are stopping you from investing today. Our team will answer them in the upcoming Q&A session. Once again, a very happy Diwali to all of you. Bye for now.